Luke, welcome back. This is your kind of environment. You want to you want to show your mug, or you didn't
Oh,
shave today?
absolutely. No, I did actually.
All
Absolutely.
right,
Hold on.
I didn't. So, we could do a talking head interview. Nice to see you,
There we
Luke.
are. Good to see you, Dale. How are you today?
All right, I'm doing good, and I mean, what a great time! When I put these schedules together, I don't really think about events surrounding them when the guests will be here, but this is your bailiwick. So, why don't we get it out of the way? What's your view of what Powell's going to do and say tomorrow?
I think he's going to continue to lean hawkish and talk about, especially with this PPI number that's coming out that you guys were just talking about. Politically, I think Blake nailed it on the head, or maybe it was Steve, but inflation's become a political issue, and quite
Right.
frankly, I've been surprised how quickly it has been. But I guess that's midterm politics in America for you. And so I think he now has the political clearance to do that. I think it's the wrong thing to do.
Yeah.
I think he's going to regret doing it. I think it's going to blow up in his face spectacularly. Probably, maybe as early as the first quarter of next year, late first quarter of next year. But we'll
Okay.
see. But I think he's going to lean more hawkish.
Do you think it's possible? There was a big question whether he'd be renominated or not. Do you think that, perhaps Biden accepted that he'd rather have, if there was going to be any kind of tumultuous market reaction to it, to get it over with now so that maybe by the fall, where the markets are recovering into the election, rather than delay it and have it tank into next November? You think that's
Intuitively,
part of it?
it's possible. Intuitively, that makes sense to me. I don't have the connections in Washington to say one way or another with any
You
real
don't have a
conviction,
red phone on that desk. Come on.
but intuitively, it makes sense. That's how I would try to manage it. I mean, look, there's no easy way out of this, and so it's a
Yeah.
very political process, and that makes sense. If you had to try to do it now.
Yeah.
I would tend to agree with that.
Okay. So let's talk about your concepts in the forest from the trees. Okay.
Sure.
And your concept of everyone thinks rates are low, and that zero, if we came off zero, it would be a big deal. But for you right now, rates are still relatively high considering the conditions that we're currently in, and you think there's a lot more room for major moves in the negative direction, and maybe that's the scenario that happens. Maybe the 10-year gets to 2, and that's just too much pressure on everything, and it reverses up there. What are you thinking, Luke?
Yeah, I think there's sort of two games being played at the same time, right? It's the short-term inflation political game, and the implications for rates and what the Fed's doing that we just talked about. And then there's this bigger picture game, the forest for the trees, if you will, which is we are in a bursting global sovereign debt bubble. If you go back over the last 20 years, we had an equity bubble. It popped. We kicked it upstairs to the banking sector via a housing bubble. It popped. That problem was kicked upstairs to the sovereign level via the bailouts and backstops of virtually everything by the government. And so now we have this sovereign debt bubble around the world, really. It's really concentrated in the West and advanced economies because at the same time, the demographics of the baby boom generation are leading trillions, tens, hundreds of trillions of off balance sheet entitlement promises to come on balance sheet. And just the sheer scale of this debt is sort of the forest for the trees view, which is to sustain this, you need significantly negative real interest rates. In other words, in a perfect world, 9.6% PPI with 0% Fed funds, that's perfect. They would, I think, absent politics, they would love to see PPI at 10 to 15%, Fed funds at 0, and the bond market sits still. They don't have to do any yield curve control in any real way, which traps them essentially permanently. and they inflate this thing away over 5 years. And in 4 or 5 years, we wake up that the GDP is at 70, 80%. And then the Fed can take the 10, can go into a true normalizing cycle. They can take Fed funds back to 2 or 3. You can get the 10-year out to 4 or 5 and nothing blows up. And I think that is the ideal situation. And I think politics in the short run, this shorter term game are interfering with that. And so ultimately, I think real rates have to go to probably -10 to -15%. And the reason I say that is if you look back in history, the last time US debt to
Yeah.
GDP was as high
World
was
War II.
right after World War II. And you saw
Yeah.
US real rates went to -14 at the Fed funds level, or at the T-bill rate. And that's not even the worst of it. I mean, if you look at nations that were more destroyed by the war, Japan, Italy, France, Australia, they had real rates anywhere from -30 to -60%. So you had extraordinarily high inflation with zero rates for anywhere from 3 to 5 years, and you got out of the debt. And I had thought that this emergency was a big enough emergency that it provided the political cover, like the war did, to basically screw bondholders on a real basis.
It's another war,
It's
type
another
of
war, right? You've heard policymakers talk about that. I've quite frankly
Yeah.
been surprised how little political currency COVID has had over the last 3, 4 months. That basically we're right back to inflation fighting, which I understand why they have. Well, why the politics of it are, but it's the wrong thing to do with that where it is.
Yeah, Paul's even using COVID to build his case, saying that the labor force and the constraints we have with trade and having our supplies being held back is lack of labor. So that COVID actually exacerbates the inflation problem.
Yeah, and that's something too this time that makes
Different.
And it's different. It's very tricky for the Fed because you have the COVID labor situation, which the Fed can't print labor. They can raising rates probably isn't going to help it, unless there's a lot more people getting rich in crypto and stocks than we think. In which case, if they take hits on their portfolios and have to go find a job, but I think that's probably a tail case. I don't think there's 5 million laborers out there that are rich on crypto now that will have to go find a job if crypto gets killed because Powell raises rates a few basis points. But that's not the only issue in terms of sort of the stagflationary impacts. I mean, you're seeing a lot of signs of what we write about as peak cheap oil and gas, which is not to say we're running out of oil and gas, but demonstrably we are running out of the cheap stuff. And to continue increasing production, if you want the economy to grow, you need to consume more energy. That is still oil and gas primarily. And if you want to increase production, you've got to increase exploration. But the costs of this stuff are higher. So Fed, thinking that they want to constrain inflation, they're going to raise capital rates, hurdle rates on this expensive oil and gas, which means it's not going to be produced on the margin. And so when they're actually thinking they're going to be reducing costs, reducing inflationary pressures that we're seeing from the energy sector right now, for example, they might actually be making the problem worse by raising rates, which again is something we've not seen in a very, very long time. And you're seeing this in other areas as well. You're seeing, battery prices are starting to rise for some of the electric vehicles, again, due to some of the ore grade constraints,
I saw a guy tweet, Luke, who said, I just ordered a new refrigerator and it'll be delivered in August. And with the tragedy with the tornadoes, a lot of transformers were damaged, out of commission. The guy's talking about it could take months, and you know why? We don't manufacture them.
We don't make.
They're in China.
Yep, they're in China, and China's having constraints, right? If you look, China's been shutting down power plants, and some of that is increasingly looking like it's a water issue. That basically everyone's known China's had a water issue forever. Everyone knew it was going to be acute someday. Even a number of Chinese policymakers were saying it's probably going to be acute within 10 to 15 years. And they were saying this in 2010, 2011, 2012. So here we are 10 to 12 years later. And you're seeing, they've got a lot of hydropower there. And so if you just take some of your marginal electric capacity off, it ripples through. And so there's a lot of factors here that the Fed can't do a darn thing about in terms of inflation and inflationary pressures. And
They
in fact,
can't
they might be
print
making it worse.
grain. They can't
Yeah.
print grain either. I mean, you look at the agricultural commodity markets, and they could take short-term rates at 20, and it's not going to break supply issue with a drought or just short crops. And I want to really move to what's going to exacerbate this problem. And I want you to explain why I'm thinking technically. You give me the fundamental argument before
Okay.
for this. So I'm expecting a high in the dollar between 98. Some people I'm looking at 98. Some
Okay.
people a little higher, 100, and the resumption of the long-term downtrend in the dollar. And I actually think that might be one of the biggest trades of the year, that there could be some type of run on the dollar. And this has just been a bear market rally from last January because the whole market was wrong-footed. Why and how can we have a bear market in the dollar in 2022?
Yeah, I think I think that makes a lot of sense, and I think how that could happen is you get the Fed addressing inflation for political reasons here in the near term, and then that forest for the trees, big picture debt issue manifests itself. And I think the way it's going to manifest itself is not just in the equity market, but more importantly in the Treasury market. I think the Fed in March 2020, if you go back and read what they said from March 2020, really through much of last year, they effectively took on a third mandate quietly. It was full employment, low inflation, and making sure the Treasury market functions properly, avoiding Treasury market dysfunction. And
Well,
so
they've had lots of fires to put out during that promise, haven't they?
they
Repo
sure have.
markets, etc.
Yes, they have. And I think that's everyone's been watching where's the Fed put struck on the equity markets. And I think that's a very valid, and I continue to watch that myself. But for me, the most sensitive metric is where's the Treasury market put? In other words,
Yeah.
where does dollar liquidity, where does the dollar trade to? Is it 98? Is it 99? Is it 100? I think that's the right range. That 98 is where I'd be looking to start for that to happen. But where's the dollar rise to where the Treasury market starts to have problems again? And the Fed has set up some programs to try to ameliorate this, standing repo facilities for domestic investors, domestic institutions, some foreign swap lines for some foreign institutions. All of those things would effectively be the same as reinstituting QE, just on a sort of day-to-day basis, as needed basis. That would begin those programs, if they began being used, would effectively mark a top in the dollar. They would be capping the dollar with usage of those facilities. And so I think when you think about fundamentally, how could we look at a world where the dollar gets to 98 to 100? I think 98 to 100 is where the Treasury market starts to break in terms, again, of its functioning, right? Where you start to have these bad auctions, et cetera. And the Fed's just not going to let that happen. Full stop. And I think we moved then to usage of some of these facilities. And if that doesn't work, then I think we move back to some sort of resizing,
Negative
re-increasing
rates.
QE. Yeah, I think they do
Yeah.
QE first. I think they're very, very reticent to go to negative nominal rates, but I think you'll see another 2-3 trillion in QE, some big number that really shocks people. And I think there will be an aha moment as it relates to how the dollar trades. I think that will be this big aha moment where I think a quorum of market participants go, "Oh my God, they really are stuck."
Yeah.
It used to be, in 2016, the dollar went to 103 and things broke. And then it went to 100 in 2000 and it broke. And then it goes to 98. So you're having this declining peak where levels of the dollar where things break. And that's just a function of the debt rising exponentially. And I think that's fundamentally, quite frankly, what you lay out there, I think that makes a ton of sense. I could see absolutely how that would play out.
Well, what fiats would you be attracted to should the scenario change? Obviously the classic would be to be moving into euros because it's a big part of the dollar index. But could there be some currency trades or positions in some of these markets and economies that have been stressed out by a strong dollar because they've denominated their debt in the dollar? And if the dollar comes off, that they'll they'll have a tailwind in their economies instead of a headwind.
Yeah, I would think in terms of, I guess, two buckets. First bucket would be those that were just really, really bad shape. Twin deficits, dollar debt,
Oh,
Turkey, Argentina, right? The ugliest of the ugly, right? Guys
yeah,
that are moving towards balance of payments crises. If the dollar got much weaker, the Fed reversed, there would just be a counter move right there, which is probably
okay,
very high beta, et cetera. That's sort of the risky
yeah.
play.
That's for people that are suicide traders.
Right, right. There's not a lot of fundamentals backing that. Now, in terms of something where I think there would be not just a reversal of the dollar strength that had hurt them, but also a fundamental driver to it, would be perhaps a Mexican peso,
Peso. Okay,
where
interesting.
you're already seeing. I mean, last week I thought it was really interesting to hear Secretary of Treasury Janet Yellen say the inflation is not going to stop, and we may need to we may need to put some protectionist metrics up to reshore manufacturing. Well, if manufacturing is coming back, and there are a lot of indicators suggesting that it is for a number of political and I think geological, just resource related reasons, I think no small part of that's going to end up back in Mexico, where it was from '94 to '01 after NAFTA was signed. So you could have a renaissance of sort of the '94 to 2000 timeframe for Mexico in terms of manufacturing moving out of China into Mexico, being sort of a long-term tailwind at the same time that the dollar was weakening.
Yes,
And so that would be interesting to me. I think you'd also want to look at a number of different commodity currencies,
right.
probably the Canadian
Aussie.
dollar, maybe the Aussie dollar as
Yeah.
well, I think would be
How about the
reversals of
ruble?
fundamentals.
How about the ruble? What do you say about the ruble, Luke?
If the
Should we
sanctions, I
wait for
think,
the invasion to buy, to buy a break in the euro, in the ruble? Wait for the invasion.
you know, left unsaid around the ruble and the sanctions, all this stuff, nobody's pointing out that everyone likes to quote the quote, Russia's just a gas station or whatever John
Yeah.
McCain said, right? Masquerading as a country. I've routinely had people say, oh, their GDP is smaller than like Maine or Texas or something. Look, the reality of the situation is this. If you subtract Russia's oil and gas from the world's supply, we
There
all
you go.
starve and freeze. End of discussion. And certainly Europe and China freeze
Yeah.
and starve. And so
It's a lot of leverage
it's a
for
lot.
Maine.
He's the most
I don't think
powerful
Maine
man in the
has
world.
that kind of leverage,
That's exactly my point. And so when you
Yeah.
translate that to the currency markets, you have this currency that is in the best fiscal shape of anyone in the world, bar none, right? They've got very low foreign debt. They've got massive gold reserves as a percent of total reserves. They are the key swing player. They're the world's biggest energy exporter. They are being run by whatever you think of as domestic policies, arguably the most thoughtful, strategic, best leader in the world. And so you have all these things on the positive side for the ruble against this sort of Damocles of, I don't want to be there when the Americans put more sanctions on him, or if he does invade, because then I'm going to be wrong for the right reason, which, as traders, we don't care.
Yeah.
We just care about
Yeah.
the first part of that statement.
Yeah. Okay. So, I'm wondering, what level in the Treasury market do you think that we might, the Fed would have to throw in the towel? Yields at 3%, or is it just that the bond vigilantes, which are newer generation of traders, don't even know what they are? That they're the ones that are going to drive the Fed to the breaking point. And so it's interesting because I always thought they were more S&P sensitive, but you're right. The way they came in during COVID in all the bond markets, the corporate debt market and junk, and they've all been under pressure. I mean, the bond chart doesn't look that great to me, and either does HYG or LQD.
Yeah, it's one of these things where there's a discussion I always hear, well, it was just a plumbing problem. Well, as a trader, just a plumbing problem is just a nice way of saying the market crashed. Everybody was on the same side of the trade and the market crashed. And the Fed had to take the other side of it. And they've had to keep doing that. And it's a structural balance of payments, debt. There are some technical plumbing issues in there as well, no question. But in terms of your question of where's the level, I think there's two levers that they have. There's the absolute level, and if you hold one side steady on the fiscal side, is lever one is the fiscal side. If you hold that steady as she goes, then I think probably 175 to the 175 to 2 range in the 10-year is where you start to see problems.
Okay.
Now, practically speaking, we're seeing them throttle back the fiscal side a bit. You've got this fiscal cliff coming up. You had Biden just come out and say, hey, student debt is going to have to start being paid again. That's a tax increase. It's basically a tax increase in February. So you're actually seeing liquidity removed by that. And so I'm not surprised to see the 10-year doing what it's doing, because I think that's the right move is there's a bunch of anti-growth policies being put in place on the fiscal side. Now, by the same token, if they reopen the throttle on fiscal, then that gives you more leeway on where the 10-year can go, where Fed funds can go, until something breaks. And it really comes down to, again, that negative real rates issue. I think once you get to, negative real rates of, whatever, 50 basis points, 60 basis points on the 10-year, 40 basis points, we've been running into problems. And that's the real side, I think, is a function of fiscal, driving inflation on a lag, and then where the nominal rate is. So right now, it just depends on how they set those levers. And like I said, it looks like they're throttling back fiscal, which gives us maybe even less leeway at the long end.
Okay. And, you think about how well commodity markets have performed, Luke, and that's with the headwind of a firm or steady or strong dollar. And I've seen bear markets in dollars. It's not bearish for commodity prices. You get at least you get at least nominal gains, and it's not, at times it's not bearish for the stock market. You can have a 30% break. In fact, after some of the crises we've had early on, the first 30% of the recovery was a 30% decline in the dollar. So
Yeah.
you could also have nominal gains there.
Yep.
So I can only imagine what's going to happen to inflation if the dollar's weakening and we still have all these supply constraints.
I think the table is set for an extraordinary extraordinary bout of inflation at some point, probably
Yeah.
in the second half of 2022, because these supply chain constraints aren't going away. When you look at something like China has water issues, that's a lot of this stuff is structural. Peak cheap oil and gas, Fed raising rates is going to make it harder to find more, not easier. When you look at
Copper.
the copper, when you look at the supply chain side, right, there's no more new container ships coming into the trade until 2024, 2025, best case, assuming there's no other delays. And so when you look at all of this and then you overlay, the 70s, we look at that inflation, US debt to GDP in the 70s was 25 to 30%. It's 125% now. There is no ability to let rates really rise to maintain even a rational or a modest negative real rates like we saw through the 70s. I mean, if inflation really gets away from them, and the bond market truly revolts, I think that's their worst nightmare, because then they would be forced basically into some sort of explicit yield curve control. And you could see a really compressed period of extraordinary inflation in the U.S. If that's the case. And I think, unfortunately, that's
It's a
probably a
possibility.
lot more than a fat tail. That's probably, I don't know that that's a base case, but there's a real shot of that happening, late 2022, early 2023. And it might be, we're sort of in a car situation, right, where they oversteered to the inflation side, and now they're panicking, and I think they're oversteering to the deflation side, and I don't think they're going to like that outcome. And sort of this secondary re-steering that we finally get the car to really spin and go into a ditch as it relates to inflation may be what happens.
Yeah, I'm really excited about the trading opportunities that I think are coming our way in
Absolutely.
2022. Almost feels like this year was a setup for what we're going to see next year
I think
in
that's
many
right.
different areas.
I
So,
think that's
you
right.
know, I want to, wish you and yours Merry Christmas and Happy Holiday, Luke. And, I hope that we could talk again as what is theorized, unfortunately manifests, and keep in touch and keep the narrative going. I appreciate that you educate people that what really negative rates could be. Because most of us in our lifetime, I wasn't around in World War II. So,
Neither was I, obviously.
yeah. So, and so anyway, it's a service that you give people your broad perspective. I encourage people to follow you. I receive your emails, and best place to do it is the name of your website. Is it Luke
Sure.
Gromen?
It's FFTT-LLC.com. Yep.
Okay, Luke, thanks so much for sharing your time and edifying the F.A.C.E community today. Had a great time talking to you.
Thanks for having me on, Dale. It was great talking again. Merry Christmas to you and yours, and we'll talk with you soon.
Yeah, we'll talk in the spring. See
That
what's
sounds
happening
great.
by then, right?
Absolutely. Absolutely.
All right,
Should be
Luke.
fun.
Thank you very
All right.
much.
Thanks, Dale. Take care, bud.
Everyone, Luke Gromen, and you have to stay on top of it. Blake is a fan of yours, so he'll be getting in touch with you, I have a feeling.
Perfect.
So thank you very much, Luke.
All right. Thanks, Dale. Take care.
All right.
Bye-bye.
So everyone, that's a wrap. Tread carefully. You could join the team in 15 minutes for the morning edge and hear more of Steve Volge. That was a teaser just to hear him pontificate about the Fed. Sure miss that guy. Steve's like me. We're both real positive guys. Anyway, thank you, everyone. Don't forget, if you want to do the $1 trial, you have to do it before our deal pops up, okay? I'll see everyone tomorrow. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.